Hello, investors and traders, and welcome to this week's market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. If you are brand new to this alert and this weekly report, understand that I keep my lines on the chart from last week's report so you can see how accurate the signals were and how accurate the forecasts were as well. And this worked out very nicely for us, where last week, you can see right here, let me zoom in just one more tick right there. Last Friday was right here, and I said that we would most likely go up to test our resistance from the high back here on the 11th of August. And the end of that line was my target for the Dow, and that's exactly where we went. Monday, Tuesday, Wednesday, we kind of hung out at that level and then moved a little bit higher. So we hit the target, blew through the target, and what does that mean for next week? Well, understand this, and I'm going to erase all of these lines right now that we hit the targets. When you're looking at a chart, you have to keep an eye on the type of candle, and you have to keep an eye on the volume. And right now, if you're following along with our trading checklist, you'll know that this is a small body candle known as a spinning top. That's a sign of indecision. And it's usually found at pivot points. You'll see that back here, right there as I magnify that, that too is a spinning top. And shortly after that, the markets dropped and then again found some support and some bullish patterns down here. But right now, that's a spinning top, possible pivot point. And why I say possible is because we have a drop in volume today as I record this on the 28th of August. And a drop in volume tells us that the buyers are starting to lose some of that momentum. We also have a gap below the market that will most likely act as a price magnet. So that is all telling us possible lower prices next week. But as I go down to the bottom of the chart, you can see that there is a divergence in the stochastics. What do I mean by that? Well, we have a higher high back here on price and on the stochastics, but we have lower highs here on the stochastics as the price reaches higher levels. So again, higher highs, but not higher highs on the stochastics is a negative divergence. Keep an eye on that. We also have a negative divergence on the CCI. See how the highs are getting lower? It's slight, but it's still significant, because as I magnify this, you'll see that the CCI is hinging lower. Once this line moves down below that red line, that would cross at a sell signal right there, and then you could look for lower prices after that. But right now, the diamonds are looking more bearish than bullish. My best advice to you would be to trail your stop up, even if it goes up on Monday and eventually pulls back later in the week. I would say trail your stops, protect your profits until we reach another level of support, and then you could re-enter the market at that particular point, especially the swing traders. We have some day traders out there that follow our reports. Keep an eye on the downside. Now, if we look at the IWM, this is the Russell 2000 ETF. I said that we would most likely bounce off a support in this area. We didn't quite go down all the way here, but we wound up exactly at my target price. Look at that. Isn't that amazing? So as I magnify that, you'll see the end of the line right there is at 156.65. And we closed. We actually opened the market right on the penny there and then went a little bit higher. Now, this particular candle is different than what we've seen in the diamonds. This, as I delete these lines here and redraw them for you, we now have a support level here, and we're going to step up the support. This candle right here has a long shadow underneath it that is very close to a hammer pattern that is considered to be bullish, right? That's the second most bullish type of candle you're going to look for. And you can see that it's bouncing off of that 20-period moving average. The only thing that keeps me from saying this is an extremely bullish sign is the drop in volume. Remember what we said before in the diamonds, the volume gives us an indication behind the force of the move, and right now the buyers aren't coming in with full conviction, but that could change on Monday. You see down here, the stochastics is crossing with a buy signal, And the CCI, as I magnify that, is crossing over that black line, which is the momentum line. That's a zero line. A lot of times, the market will go up, or the stock will go up after that line is crossed, and that's exactly what's happened. So for the Russell 2000, being that this is a broader based index of small cap stocks, I think the Russell could go up next week. And the end of that line will be my target right there. And I will leave that for you, just like that. Let's hop over to the VIX. The volatility index, also known as the fear index, is something we have to pay very close attention to, but we're getting mixed signals here on the VIX, and pay close attention here right now. Last week, I said the VIX would drop and bounce off of this support level. If you don't believe that, go right back and listen to the recording from last week. I keep that archived so you can see the evidence with your own eyes. I said we would drop, test that support, bounce, with the end of that line being the target. So we hit that precisely. But what does that mean for next week? Well, we hit this target resistance up here as well, and you can see these long shadows on top of the VIX. This candle pattern right here, long red, surpassing and engulfing or even eclipsing the green, is a bearish engulfing pattern. The CCI is going lower. We got a candle pattern that's lower. CCI is going lower. So that means we could see lower prices on the VIX. Now, because this is inversely related to the S&P, that would be bullish, right? And here's where we get the conflict. Last week I said the VIX would go up. It did that. And because this is a contrarian indicator, you would think that the S&P would have gone down. Well, guess what? It did not. In fact, on one day, Wednesday, we saw the VIX and the S&P rally, which is something you normally don't see. So this is where we get the conflicting signals, and that I believe that while the S&P will go lower to pull back to that moving average, we did not hit that target right there from last week, but I'm going to extend that out. I think eventually we will. It's getting very tight on the upside. We see drops in volume right here. The stochastics are getting ready to cross. The CCI is going lower. But what does that mean when the VIX is conflicting with the S&P? Well, we have to be more defensive. That's what that means. So because of the VIX, I think that we are going to go a little bit higher on the S&P early in the week. You have to keep an eye on this on Monday, but eventually I think we're going to pull back just like that, with the end of that line right there being my target. Keep an eye on that CCI down there, because if we ultimately see a cross below that red line, that would be a sell signal for the S&P. Now let's hop over to the tech sector, which is represented here in the Qs, QQQ. That's the Q shares for the market, basically representing the NASDAQ. And you can see, again, we did not hit the target, but listen, that's not too bad for those who have taken a long position, because if I'm saying that we could possibly pull back, but you're doing a good job protecting your profits with trailing stops, then you still made money this week in the Qs. Now, if you're short or were short, you have to keep a close eye on the candle patterns and put buy stops in. That's a little bit more sophisticated strategy for those novices who don't know what I'm talking about with short selling. But I'm going to move this on over, and I'm going to even increase the angle on the way down. I think that the Qs could very well start to pull back and even match what was right here, the bullish engulfing pattern. I think we're going to pull back to this point, and by then the 20-period moving average will have extended up. I'm even going to forecast the 20-period moving average, and at that point we're going to have an intersection right here. I believe that's what the markets are going to do next week. So keep an eye on that. I'm going to erase this because we have a new support level, but look down here as I magnify that. That is a cross on the stochastics. Again, going through the checklist, we have a doji, or close to a spinning top, sign of indecision, usually found at pivot points. We have a wide divergence from that moving average called the rubber band effect. We have gaps below the market. You can't see it on this chart, but we have gaps below the market right down here that are not filled yet. And we have a drop in volume on the way up after a series of higher volume bars. This drop in volume, which is about 30% less of what we saw yesterday, is telling us the buyers are getting tired. You can see that the stochastics here is crossing with a sell signal, and the CCI not quite at a sell signal yet, but it's hinging lower. Keep an eye on the tech sector because we have stocks that are looking very tired right across the board. We have the FANG stocks, we have Facebook, we have Amazon, Netflix, Google, you name it. They're all starting to look a little tired. Again, that doesn't mean an absolute sell-off is going to happen next week, but I'll tell you something. I believe that many of these traders who have built-in profits are going to be very quick to take those profits, and any kind of a profit-taking selling activity will push those prices lower. So you have to protect the profits, especially as we reach for higher levels. So that's it for now. Have a great weekend, and we'll talk to you soon. So long.